Hey investors, last week I did two option trades and I want to talk about it in this video. Specifically, I did one option trade involving Facebook and I did another one involving a company called Livongo. For Facebook, the stock had risen quite a bit last week due to the speculation of TikTok closing its operations in the United States. So I thought I could do a covered call on that. Livongo was also a stock in the news last week because of a potential merger with another company called Teladoc. So I'll go through the specifics of the option trades in this video. So let's go through the Facebook trade first because that is relatively simple. Basically, I sold a covered call for 100 shares for Facebook at a strike price of $295. Currently, Facebook trades around the range of $260. So to hit that strike price of $295, we will have to rise by about at least 10% by the end of this week. The expiry for the option is 14 August 2020, which is this Friday. So since I thought Facebook had risen a little too fast last week, I thought I'd take advantage of the high price and sell this option, this call option. But I don't sell a blanket call option, also known as a naked call option. I sold a covered call option. I already have more than 100 shares of Facebook, so I could use those shares as part of the call option that I want to sell. So basically, I don't lose any money in this option trade. Usually in a call option, which you sell, you don't want the stock to go up above the strike price. And if it does go above the strike price, say 300, then you lose the money. Basically, you lose the amount of money between the market price that the option expires at and the strike price. So if you went up to 300, difference would be $5, and you take 5 times 100 shares and you lose $500. But since I'm selling a covered call, I won't lose any money even if it goes to 300. What I lose is the potential profits of $500 for those 100 shares. So why did I want to do that? Because I was being offered a premium of about $70 to take that risk. So I don't lose money even if Facebook goes through the roof. Of course, I do lose the potential for those profits. But I did not think that Facebook was going to go through the roof this week, basically. I think there's a very slim chance of Facebook hitting 295 and above and crossing the strike price. If it does cross the strike price, I may lose my 100 shares. I get money in return for those 100 shares, but I lose the upside potential for anything above the strike price of $295. There are only a few stocks that I have 100 shares of, so I can use them for covered calls. Facebook is one of them, and I think the other one is Upwork. I made quite a bit of money on selling put options for Upwork while it was falling. And now that Upwork has risen so much, I've made money through the premiums, and also sometimes those stocks were assigned. And as the price rose, I made money in terms of the price appreciation of those shares. But I think Upwork has also risen a little too much too fast. So I might use a covered call strategy to gain some premium income from those shares. So this trade is already profitable so far. By the end of the week, if Facebook stays below the 295 strike price, this should go up to the premium that I received of $70. and the option expires, and that's the end of the matter basically. So for the Livongo option trade, I basically just sold a put option. But Livongo is a very new company to me. The reason I got interested in it is because of this merger that is ongoing. Teladoc has been a star of the COVID pandemic. It is a leader in telemedicine, and its stock has soared during this period. I was interested in Teladoc, but of course the price did not seem right because it had risen too much. After Teladoc and Livongo announced their merger, both of their stocks dropped significantly. I think the price was still not attractive enough to buy shares, but I thought I could make some money by selling a put option. I don't mind getting the shares of the eventual company if the strike price is hit and the shares are assigned. I think the merged company will be a very strong company. It combines the best of two worlds in terms of Teladoc being the leader in telemedicine and Livongo being a very growth focused upstart in digital health. So I think this newly merged company will be quite strong and quite a formidable competitor. The moat I see here in terms of Teladoc is in its network effect, since it has a very large network of doctors that makes it more attractive to patients, and then having a lot of patients makes it more attractive to doctors. And adding more features and services like those that Livongo provides, I think makes it an even stronger proposition. So basically, every Livongo shareholder gets about 0.592 shares of Teladoc and $11.33 in cash. And based on the price at the time this article was written on Friday after the market closed, this represents a value of about $126. Like I mentioned, both Livongo and Teladoc fell quite a bit. Livongo fell about 16% and Teladoc fell about 22% since the details of the merger were announced. And just because the prices fell doesn't mean that the merger is a bad deal. There are probably shareholders in both of these companies who decided that they had made enough money perhaps and they wanted to sell their shares and maybe do some profit taking. So I won't go too much into the details of the deal, but let's just take a look at this. The combined company will have an expected 2024 forma revenue of approximately 1.3 billion, up 85% versus 2019. So granted, I mean the growth rate is so high because of the pandemic, and once the pandemic subsides, the growth rate is expected to moderate. But it is still quite a significant growth rate. And then they're expected to be revenue synergies and cost savings for the combined company. So with Teladoc trading at $193 and Livongo trading $120, there was also some arbitrage opportunity. So basically, one Livongo share will equal 0.592 times 193, which would be 114.68, plus the $11.33 in cash, and so that will equal $126. And Livongo was trading at about $120. So there was some minor arbitrage opportunity there as well. That's of course provided that Teladoc shares stay at 193 or above. Teladoc is still quite a volatile share, quite a volatile stock. So don't expect it to just go in one direction. It could go below 193. So I was very conservative in the put option I sold. And let's look at that right now. So I sold a long dated put option for 16 September 2020. This is 2 years from now. I sold it at the strike price of $30 and I collected $220 in premium. For the shares to be assigned, Livongo, or at least the new Teladoc, would have to fall about 75% according to my calculations. Of course, by September 2020, there won't be any Livongo anymore. It will be the new combined company. So I think the broker will adjust the put option accordingly. But as it stands, as I said, Livongo trades at about 120, so it will have to fall about 75% for the shares to be assigned. And I think if the shares are assigned at $30, that may actually be a good price to start building a position in that combined company. So I know that it is 2 years from now and anything can happen. But I think digital health is a secular trend, and I don't see it abating anytime soon. I think now that Livongo has established itself as a leader, at least in the niche that it serves, I think it can continue to move higher. And more importantly, I think with the support of Teladoc and as a combined company, I think it can go much higher. So I don't think it's likely that the strike price will be reached or that the shares will be assigned. So I think I will be able to collect the premium in a very low risk situation. It's not as clean as the Facebook trade, which just basically ends this week, and I get $70 for that. But I think the other thing about this is that it gives me some skin in the game, so I become more attentive to Livongo and Teladoc. I read up more about it since I have at least some money at stake now. So those are the two option trades I did. Let me know what you think about them. What are your comments? Did I do my analysis right? Are they really low or no risk? And should I do more actually?